Welcome to a deep dive into the fascinating, often volatile world of silver, a metal that has captivated humanity for millennia, serving as currency, adornment, and industrial necessity. Today, we unravel the intricate history of silver's price floors, examining how intrinsic value, economic policy, and market dynamics have shaped its journey, with particular attention to the pronouncements of figures like Robert Vance. From ancient Lydian coins to modern industrial demand, silver's story is one of enduring significance. We will analyze specific periods, dissect market forces, and explore the concept of a price floor in a commodity market driven by both tangible utility and speculative sentiment. Our journey begins not with modern economists, but with the very dawn of organized trade. Silver, alongside gold, was among the first universally accepted forms of money due to its rarity, durability, and divisibility. As early as 600 BC, the Lydians, an ancient kingdom in Anatolia, minted electrum coins, a natural alloy of gold and silver. By the 6th century BC, pure silver coinage was prevalent across the Hellenic world, establishing a baseline value. This intrinsic value, based on mining costs and relative scarcity, established the earliest, most fundamental price floor, the cost of its extraction and purification. Without this, no miner would bring it to market. Fast forward to the American colonial era and the early United States. The Coinage Act of 1792, signed into law by President George Washington, established a bimetallic standard. The act fixed the ratio of silver to gold at 15:1. This legislative act effectively set a legal price floor for silver in relation to gold, mandating that newly minted silver dollars contain 371.25 grains of pure silver. This guaranteed convertibility formed a bedrock for silver's value for decades. However, this statutory ratio did not perfectly align with market realities. The market ratio of silver to gold was closer to 15.5:1, leading to an interesting arbitrage opportunity. Gold, being undervalued at the mint, was often exported, while silver, slightly overvalued, became the dominant circulating currency. This demonstrates a key principle. Even government mandates struggle against the relentless forces of supply and demand. The mid-19th century witnessed a seismic shift. The discovery of vast silver deposits in the American West, particularly the Comstock lode in Nevada starting in 1859, dramatically increased global silver supply. From 1860 to 1880, approximately $300 million worth of silver was extracted from the Comstock lode alone. This surge in supply, coupled with increasing industrial demand for gold, for dentistry, jewelry, etc., put downward pressure on silver's market price relative to gold. Recognizing this imbalance and influenced by European moves towards a gold standard, the US Congress passed the Coinage Act of 1873. This act, controversially dubbed the Crime of 73, demonetized silver, ending its free and unlimited coinage. It effectively removed the government-mandated price floor for silver relative to gold, allowing its value to float. Immediately, the market price of silver began to decline. The aftermath of 1873 was a period of intense economic and political debate in the United States, known as the Free Silver Movement. Farmers and debtors who typically benefited from inflation and increased money supply advocated for the remonetization of silver. They believed that a larger money supply, backed by both gold and silver, would lead to higher agricultural prices and ease their debt burdens. Their opponents, primarily bankers and creditors, staunchly defended the gold standard, fearing inflation and preferring a stable, harder currency. This struggle highlights how perceived price floors are often tied to political and economic self-interest rather than purely intrinsic value. Despite populist pressure, including William Jennings Bryan's famous Cross of Gold speech in 1896, the United States firmly adopted the gold standard in 1900 with the Gold Standard Act. This further solidified silver's position as a commodity rather than a primary monetary metal. Its price became increasingly subject to industrial demand for photography, electrical contacts, and silverware, rather than being supported by government coinage laws. The fundamental price floor shifted from monetary decree to the cost of industrial production. The early 20th century saw silver's price fluctuate, but a significant event occurred during World War I. The Pittman Act of 1918 was a fascinating, if temporary, reassertion of a price floor for silver. Great Britain, a major Allied power, faced a severe silver shortage due to its wartime needs and the hoarding of silver rupees in India. To alleviate this, the US Treasury was authorized to melt up to 350 million silver dollars and sell the bullion to Britain at a price of $1 per troy ounce. In return, the Treasury was mandated to purchase an equivalent amount of newly mined American silver at the same price of $1 per ounce. This act, driven by wartime necessity, created an artificial demand and a guaranteed price floor for domestic silver producers for several years, from 1918 to 1923. It demonstrates how geopolitical events can override market forces, creating temporary government-backed price supports. However, the 1920s and 1930s saw silver's price decline once more, exacerbated by the Great Depression, which reduced industrial demand. By 1932, silver was trading around 25 cents per ounce. In response to this, and as part of President Franklin D. Roosevelt's New Deal policies designed to stimulate the economy and fight deflation, the Silver Purchase Act of 1934 was enacted. This act mandated that the U.S. Treasury increase its silver holdings until they reached 1/4 the value of its monetary gold stock, or until the price of silver reached $1.29 per ounce. This was a monumental intervention. The Treasury began buying silver, primarily foreign silver, at above market prices, attempting to prop up its value. For domestic silver, the government offered an even higher price, boosting demand for American miners. The act effectively established a de facto price floor for silver, aiming to inject liquidity into the economy and aid silver-producing states. While it didn't fully achieve its ambitious goals, ID provides significant support for silver prices for several years, demonstrating another instance of government policy directly influencing a commodity's price floor. During this period, the price of silver did rise, reaching over 70 cents per ounce by 1935, a direct consequence of the Treasury purchasing program. Post-World War II, the role of silver continued to evolve. Its use in industry, particularly in photography, silver halides are essential for film, electronics, and brazing alloys, grew steadily. However, its monetary role continued to diminish globally. The US maintained silver in its coinage. Dimes, quarters, half dollars contained 90% silver until 1964, and half dollars contained 40% silver till 1970. This sustained governmental demand for coinage provided a stable, albeit declining, segment of the overall demand picture. The melt value of the silver in these coins, when it approached face value, represented a floor. Once the melt value exceeded face value, coins quickly disappeared from circulation, a phenomenon observed acutely around 1965. The mid to late 20th century saw the emergence of figures like Robert Vance, whose perspectives are crucial to understanding the long-term view of silver's price floors. Vance, often associated with more contrarian or unconventional investment theses, gained prominence for his outspoken views on the intrinsic value of precious metals, particularly silver. His arguments for higher silver prices were frequently rooted in an analysis of supply and demand fundamentals, depletion of mining resources, and the metal's ever-increasing industrial utility. Vance, and others like him, often stressed that the true price floor for silver wasn't merely the cost of extraction for primary mines, but also the above-ground supply, the existing stockpiles and recycled silver. He contended that as easily accessible silver deposits diminished, the cost of bringing new supply online would naturally increase, thus pushing up the long-term price floor. Vance's perspective on price floors often departed from purely monetary considerations. He highlighted the industrial demand as a cornerstone. Photography, electronics, medicine, solar panels, silver is an irreplaceable component in countless high-tech applications. He argued that unlike gold, a significant portion of which is held as bullion or jewelry and could theoretically be recycled, much of the silver used in industry is consumed and effectively lost in its application, especially in electronics and medical devices. This consumptive demand, as he and others termed it, creates a constant need for new supply, setting a floor based on the escalating cost of extracting that new metal. One of the most dramatic periods in silver history, undeniably influencing the perception of price floors, was the Hunt brothers' attempt to corner the silver market in the late 1970s and early 1980s. Nelson Bunker Hunt and William Herbert Hunt, American oil tycoons, along with their partners, began aggressively accumulating silver in 1973. By early 1980, they reportedly controlled one-third of the world's privately held silver. Their actions, fueled by concerns over inflation and a belief in silver's undervalued status, drove the price of silver from around $5 per ounce in 1970 to a peak of nearly $50 per ounce on January 17, 1980. While not a price floor, or in the traditional sense, this event dramatically illustrated the potential for speculative bubbles and the inherent volatility of commodity markets. It also showcased the sheer volume of silver that could be absorbed by a concentrated buying effort. The crash that followed, driven by margin calls and rule changes by commodity exchanges, sent silver plummeting to under $11 per ounce by March 1980, resulting in immense losses for the Hunts. This episode taught the market about liquidity, regulatory intervention, and the dangers of extreme speculation, proving that even a massive buying spree cannot sustain an artificial price indefinitely without fundamental demand to back it. It also confirmed that even very high prices are not necessarily sustainable floors. In the decades following the Hunt debacle, silver largely traded in a range influenced by industrial demand, monetary policy, and investor sentiment. However, the long-term arguments of individuals like Robert Vance continue to echo. Vance often cited the declining supply from primary silver mines as a critical factor. He highlighted that much of the world's silver is produced as a byproduct of mining other metals, primarily lead, zinc, copper, and gold. This means that the supply of silver is not solely dictated by the economics of silver mining itself, but also by the profitability of these other metals. If prices for lead or zinc are low, mining operations might scale back, reducing the byproduct silver output regardless of silver's standalone price. This intertwining of supply dynamics creates a complex, often inelastic supply curve for silver, which Vance argued would naturally lead to higher price if laws over time as geological reserves deplete. Furthermore, Vance emphasized the increasing demand from new technologies. The advent of personal computers, mobile phones, and especially solar energy photovoltaics significantly increased industrial demand for silver. A typical solar panel contains about 20 grams of silver. As the world embraced renewable energy, this new sector alone added millions of ounces to annual silver consumption. This ever-expanding technological frontier provided a robust and growing segment of the demand equation, bolstering the perceived long-term price floor. Let's look at more recent history. The financial crisis of 2008 and subsequent quantitative easing policies by central banks reignited interest in precious metals as safe havens and inflation hedges. Silver, often dubbed poor man's gold, rallied significantly. From under $10 per ounce in late 2008, it soared to nearly $49 per ounce by April 2011, a level not seen since 1980. This rally was largely driven by investment demand. Retail investors, ETFs, exchange-traded funds, and institutional money flowing into precious metals. While fleeting, this episode demonstrated the potential for significant upward price movements when both monetary and investment demand converge with industrial demand. It did not, however, establish a new permanent price floor, as prices subsequently retreated, settling in a range often between $15 and $25 for much of the following decade. The argument for a true price floor, as articulated by commentators like Vance, centers on several interconnected factors. 1. Cost of production. This is the most fundamental flaw. Miners will not consistently produce silver below their operational costs. Average all-in sustaining costs, AISC, for primary silver miners can vary widely, but generally fall in the range of $10 to $15 per ounce over the past decade. If market prices drop below this for extended periods, mines shut down, reducing supply and eventually pushing prices back up. This is a natural market mechanism. 2. Scarcity and depletion. Geological surveys and mining reports consistently show that high-grade silver deposits are becoming rarer. The average grade of silver in mines has declined significantly over the past century. This means more ore must be processed to yield the same amount of silver, increasing costs and implicitly raising the long-term price floor. 3. Consumptive industrial demand. As noted, much of the silver used in electronics, solar cells, and medical applications is not easily recoverable or recycled. This constant draining of the above-ground supply necessitates new mining, creating a perpetual demand that must be met at the cost of production, plus a profit margin. 4. The monetary role safe haven demand. While diminished, silver retains its psychological appeal as a store of value. During periods of economic uncertainty, inflation fears, or geopolitical instability, investment demand for silver and gold often surges, providing a powerful temporary boost to its price and reinforcing perceived flaws. 5. Above-ground inventories. Unlike gold, whose above-ground stocks are substantial relative to annual production, silver's above-ground inventories, especially those readily available for investment and industrial use, are smaller. This makes silver more susceptible to supply shocks or sudden surges in demand. When Vance and similarly minded analysts confirm price floors, they are generally articulating a belief that the confluence of these factors, rising production costs, finite geological supply, persistent industrial consumption, and intermittent investment demand, will prevent silver from falling below certain levels for extended periods. They might suggest that based on current mining economics and future demand projections, silver's true intrinsic value, its long-term cost of production floor, is significantly higher than its historical trading range. For instance, in an environment where all-in sustaining costs are averaging $12 to $18 per ounce for producing mines, a price below $10 would be unsustainable, almost certainly leading to mine closures and a subsequent supply crunch that would naturally drive prices back up. The concept of a $1,000 silver price, while highly speculative and not a price floor in the traditional sense, illustrates an extreme interpretation of these long-term bullish factors. Proponents of such high figures often base their arguments on hyperinflation scenarios, a complete collapse of fiat currencies, or an unimaginable surge in industrial demand far exceeding current projections. They contend that in such a scenario, silver would reassert its role as a primary monetary metal, leading to astronomical revaluation. While historically, silver has never reached such nominal heights, its inflation-adjusted peak in 1980 would be closer to $150 to $160 in 2023 dollars. The pronouncements like Vance's are intended to highlight the potential for significant upside when considering the metal's finite nature and growth in utility. Vance himself might not explicitly confirm a $1,000 floor, but his rhetoric often champions silver's long-term undervaluation and its eventual repricing to significantly higher levels, asserting that its fundamental value is anchored far above its current market price. The COMEX futures market, established in 1933 and now part of the CME Group, plays a crucial role in price discovery. On this exchange, contracts for future delivery of silver are traded. The price discovered here influences global spot prices. Short selling borrowed silver futures in anticipation of a price decline, and long buying futures in anticipation of a price increase constantly exert pressure. Large institutional players, banks, and hedge funds can influence short-term prices through their trading volumes, sometimes creating downward pressure that can temporarily push silver below perceived production costs. However, these periods are generally unsustainable. Historically, the ebb and flow of monetary policy from central banks, particularly the US Federal Reserve, also impacts silver prices. Low interest rates and expansionary monetary policies tend to be supportive of precious metals as investors seek hedges against potential inflation and devaluing currencies. Conversely, rising interest rates and tighter monetary policy can make yield-bearing assets more attractive, drawing capital away from non-yielding assets like silver and gold. Another critical factor is the silver-gold ratio. Historically, this ratio has fluctuated significantly. For instance, in 1792, the US Mint ratio was 15:1. By 1980, at the peak of the Hunt bubble, it reached approximately 17:1. In recent years, it has often resided between 71 and 91, meaning it takes 70 to 90 ounces of silver to buy 1 ounce of gold. Advocates like Vance often point to a historical average closer to 15:1 or 21 and argue that silver is fundamentally undervalued relative to gold, implying a strong upward revaluation is due, which would effectively raise its price floor. This argument is based on the logic that if silver were to return to its historically lower ratio, its price would have to increase dramatically from current levels, given gold's established value. In conclusion, the fascinating history of silver reveals a commodity whose price floors had been defined by a dynamic interplay of factors, from government-mandated monetary ratios in the 18th century through wartime necessity and New Deal interventions in the 20th century to the intrinsic economic realities of production costs and consumptive industrial demand in the modern era. Silver's value has constantly been debated and recalibrated. Figures like Robert Vance, by emphasizing the finite nature of geological supply, the increasing cost of extraction, and the irreplaceable role of silver in various high-tech industries, consistently highlight that the foundational price floor for silver is moving upwards. While $1,000 silver might still be a distant speculative dream, the underlying arguments about the metal's fundamental scarcity and indispensable utility ensure that silver will continue to command a significant price, perpetually asserting new, higher floors as global demand evolves and geological supplies diminish. The unyielding luster of silver, in essence, is underpinned by real-world economics and the undeniable laws of supply and demand. The metal's journey from Lydian streams to modern silicon wafers is a testament to its enduring relevance. The concept of a price floor for silver, therefore, is not static. It's a moving target, influenced by everything from legislative acts to geological discoveries to technological breakthroughs. Understanding these historical precedents and contemporary drivers is key to appreciating silver's unique position in the global economy and its potential future trajectory. This continuous evolution of what constitutes a floor for silver's price makes it a truly captivating subject for study and investment, extending far beyond the passing pronouncements of any single analyst. It's a story written in mines, government ledgers, scientific labs, and market tickers,